What if I told you a chatbot beat the S&P 500 by more than double in just 1 year? No hedge fund, no analyst, just AI picking stocks. Sounds crazy? I thought so too. Exactly 1 year ago, I ran an experiment. I asked some of the world's most popular AI chatbots to pick 10 stocks each with one simple goal: beat the S&P 500. ChatGPT, Microsoft Copilot, Perplexity, and even a lesser-known AI called Finch all built their own portfolios using the same prompt on the same day. Then I did nothing. I waited 1 full year. Today, we're opening those portfolios to see which AI failed, which one won, and whether artificial intelligence can really outperform the market, or if this was all just luck. Let's rewind the clock and find out. What if exactly 1 year ago you had trusted artificial intelligence to invest your money for you? No emotions, no gut feelings, no late-night market anxiety, just pure algorithmic decision-making. That's the question behind this experiment. To test it properly, I went back in time to December 2024 and asked a simple but bold question. Can AI actually beat the S&P 500? Instead of guessing or cherry-picking results, I locked everything in on day one. The same rules, the same time frame, and the same benchmark. Each AI was asked to select 10 stocks with the goal of outperforming the market over the next year. No changes, no adjustments, no human interference. Then I waited for an entire year. This wasn't about short-term hype or lucky trades. It was about real performance over real market conditions. The goal wasn't to prove AI is perfect, but to see how close it can get when given a clear objective. The results, as you're about to see, were far more surprising than anyone could have expected. To make this experiment fair, I didn't rely on just one AI. I used multiple popular chatbots, each with its own style and logic. ChatGPT produced a portfolio dominated by big, well-known tech companies, names most investors already recognize. Microsoft Copilot took a different route, mixing growth stocks with riskier picks that promised high upside but came with serious volatility. Perplexity surprised me by dividing its portfolio into growth and dividend stocks, creating a more balanced and diversified approach. Then there was Finch, later renamed Fiscal AI, which leaned heavily into industrials and semiconductors, focusing on companies tied to long-term infrastructure and technology trends. What was fascinating was how different these portfolios looked, even though the prompt was exactly the same. This showed that AI isn't one single brain. It reflects the data sources, training methods, and assumptions behind each model. In a way, this became an Olympics for chatbots, with each AI competing under the same conditions, but using its own strategy to win. When the results came in after 1 year, Microsoft Copilot's portfolio was the first disappointment. While it did manage to stay positive, the gains were under 7%, far below the S&P 500's 14.5% return. A few bad picks dragged the entire portfolio down. Some healthcare and biotech stocks suffered massive losses, and one major tech-related investment collapsed by nearly 70%. Even though some positions performed well, the damage from those losers was too large to ignore. This highlighted an important lesson. Diversification alone isn't enough if risk management is weak. Copilot's approach leaned too heavily into speculative names without enough downside protection. Compared to a simple S&P 500 ETF, the portfolio just didn't justify the extra risk. This part of the experiment showed that AI can absolutely make mistakes. And when it does, it can make them at scale. ChatGPT's portfolio, on the other hand, delivered a much more impressive performance. After 1 year, it was up around 18%, clearly beating the S&P 500. The reason was simple. It played it safe. Most of the portfolio consisted of mega-cap technology leaders, companies with strong balance sheets, dominant market positions, and consistent earnings growth. Even though one stock suffered a major decline, the gains from giants like Nvidia, Apple, Microsoft, Meta, and Google more than compensated for the loss. This showed that sometimes the boring strategy wins. Instead of chasing speculative upside, ChatGPT focused on proven winners riding long-term trends like AI, cloud computing, and digital advertising. It wasn't flashy, but it worked. This result alone raised an uncomfortable question for active investors. If an AI can outperform the market simply by selecting quality leaders, how much value is traditional stock picking really adding? Then came Perplexity, and this is where things got interesting. Its portfolio returned nearly 28% in a single year, dramatically outperforming both the S&P 500 and ChatGPT. What set Perplexity apart was balance. By combining growth stocks with dividend-paying companies, it reduced volatility while still capturing upside. Even the worst-performing stock was nearly offset by dividends, resulting in minimal damage. Meanwhile, the winners delivered massive gains, especially in technology and healthcare. Stocks like Taiwan Semiconductor, Shopify, and AstraZeneca drove the portfolio higher, showing that smart diversification doesn't mean sacrificing returns. This approach demonstrated a more portfolio manager mindset rather than a stock picker mindset. It wasn't just about finding the biggest winner. It was about constructing a system that worked across different market conditions. But the biggest shock of all came from Finch, later known as fiscal AI. Its portfolio delivered a staggering 36.5% return, more than double the S&P 500. This wasn't T-luck driven by a single stock either. While there were a couple of losers, the winners were extraordinary. Semiconductor equipment companies exploded higher, some doubling in value. Industrial machinery and internet software added strong gains, creating a portfolio perfectly aligned with global investment cycles and technological expansion. Even a stock that stopped trading mid-year due to an acquisition didn't derail the results. The sector allocation turned out to be the secret weapon. Heavy exposure to semiconductors and industrials during a strong growth phase created massive upside. This final result was both impressive and unsettling. It proved that AI, when aligned with macro trends, can outperform not just the market, but most professional investors. Still, this experiment isn't investment advice. It's a reminder that AI is a powerful tool, not a crystal ball, and the real test will come when markets turn red. So what does all of this really mean? It doesn't mean you should blindly hand your money over to a chatbot and hope for the best, but it does mean we've crossed an important line. Artificial intelligence is no longer just a research tool or a fun experiment. It is capable of building portfolios that can compete with and sometimes outperform the market itself. That's exciting, but it's also a little uncomfortable. Because if AI can do this with a simple prompt and no emotions, it forces us to rethink how investing decisions are made. At the same time, this experiment proves one timeless truth. Risk still matters, diversification still matters, and bad picks can hurt, no matter who makes them, human or machine. This was just 1 year, during a mostly favorable market. The real test will be how these AI-driven strategies perform over longer periods, and especially during a major downturn. So for now, treat this as what it is, a fascinating experiment, not financial advice. Do your own research, understand what you invest in, and use AI as a tool, not a replacement for thinking. If you found this experiment interesting, stick around because this journey is far from over. The next chapter will be even more revealing.